So I'm going to kick it off just asking everybody to introduce themselves and maybe a little bit about their organization and their investment philosophy.
Good afternoon. I'm Dave Schulte from Qualcomm Ventures. And McKesson is a Fortune 1100 or Fortune 11 company, excuse me. And we serve nearly all the customers in the healthcare ecosystem in the form of healthcare services and technology solutions. So everyone from payers and providers to retail pharmacy and pharmaceutical manufacturers. And McKesson Ventures is a 18-month-old effort. It's a $250 million fund, and we're focused on investing in IT services and tech-enabled services.
Fantastic, Dave. I'm Jack Young with Qualcomm Ventures. I also work at DRX Capital, so maybe just take a little time. Qualcomm Ventures is part of a Qualcomm. Qualcomm Life Fund is a fund that dedicated to digital health. We started in 2011. We have made 12 investments. Many investments, actually portfolio company over here today, Practice Fusion, LifeCore. Our best investment, probably everybody knows, is the Fitbit and where I'm wearing on my sleeve now. And so that's the Qualcomm Life Fund. And on the heel of Qualcomm Life Fund, we launched our second fund, DRX Capital, which is a joint fund by Novartis and Qualcomm. My partner, Caroline, was here this morning. So that fund is, again, it's pretty new, 14 months old. And now we have made 3 investments. Probably one of the investments most people know is Armada.
And I'm Nancy Brown. I'm from Oak HCFT. And for all the people who stopped me to ask me what those initials are, HC is healthcare, FT is fintech. And we are a fund that's spun out of Oak Investment Partners, led by Annie Lamont. And she raised a $500 million fund about 18 months ago and expanded the team from 3 to about 6 of us. We've done 12 investments in 18 months, which feels like a lot. 6 of them in healthcare. We primarily have tech-enabled services, meaning hardcore service companies. So examples, we have a palliative care company, we have a mental health company, primary care company, and a number of other things. But we really like people taking on really hardcore problems in the industry and throwing really good operations people into the mix to manage providers, and then using all the tech enablement that you hear about to make them efficient.
Hi, my name is Steve Barsh from DreamatHealth from Philadelphia. DreamatHealth is a venture accelerator. It's been around since 2008. We've accelerated about 220 companies worth about $1 billion to today. 3 years ago, we started DreamatHealth, just focused on digital health companies. We've accelerated about 30 companies over the last 3 years. We do that in partnership with Penn Medicine and Independence Blue Cross in Philadelphia, Johns Hopkins in Baltimore, and we also do it out of New York, focusing largely on digital health and digital health companies, so cohort-based 4-month program where we make investments and we do both kind of the soil to seed round, and then we're also doing a lot of newer digital health companies that are post-seed, pre-Series A coming in for acceleration across that gap. They're worried about the funding gap, so we accelerate them across that.
I'm Tony Miller, Ulema Ventures. We're out of Minneapolis. We are a healthcare services investor out of 2 funds. We've done 12 companies. We do a couple things differently. We don't subscribe to portfolio theory, so we actually like to start early and stay long. I think if you look at any healthcare return matrix, pick any time frame you want, that's the recipe to actually make substantial returns, is start early and stay long. Digital health will actually support that, and we'll get to that in the panel. But so we like to do things that are either with the financing of healthcare or the delivery of healthcare or anything in the constellation that makes those 2 things happen.
Great, thanks everybody. So Tony, while we got you talking, maybe we can start out at that end here. But can you talk a little bit about subsectors that look interesting to you, getting a lot of attraction here either today and where you see in the future in terms of subsectors within healthcare?
Well, I think given the amount of investment that's occurred over the last 2 years, it's hard to describe anything as a subsector at this point. So, in fact, if I was put on the spot and said, what is a subsector, I would say the secondary market's going to be the subsector that's going to emerge in the next, call it, 4 to 5,
Coming back
quarters.
again.
Yeah, I mean, I think, look, if you take the debt on top of the equity that's been put in place, you've got $13+ billion that has been put into a market that is all chasing the same market. Even though it's a giant market, it's very slow. It's the market of Luddites. I mean, it just moves slow. That's why we've got so much regulation. And so for us, it's really about, right now, what we're doing is looking at kind of companies that have an interesting idea, but might be what I call a vertical application that doesn't cross over, and we need to actually figure out what would that marry with really well and see if we can make those combinations happen. So I think a lot of that kind of thing is going to happen. M&A roll-up, combination kind of things. I don't think of a specific idea that doesn't have 10 companies that are all chasing it already.
Other thoughts from others on the panel? Steve?
Of sectors, there's things at DreamIt we see patterns. So the current cohort of DreamIt, we're going to bring in 15 digital health companies from around the world all at once. Patterns that we see, if there's subsectors, mental health. It's a really hard problem to solve. There's some people trying to attack it. We see new, really intriguing ways. Smoking cessation, things that are really, really hard, but looking at some really interesting technologies in that space. Then there's just all the things related to data. Data integration, companies like Redox, which is a DreamIt company. Those would be some of the patterns that we see of companies or subsectors.
I think the mental health is actually a very interesting space. As you know, it's very difficult to develop drugs, lots of side effects, and the conventional method, which is typically face-to-face, not scalable. Mm-hmm. To me, that's actually one of the most interesting things in the tech industry is actually just about to providing a tremendous platform, which is the VR, right? So think about it. If you have this immersive experience where you wear a headband, potentially you can gather your EEG. If you really go fancy, you can do the neurostimulation right there as well. You can do 2-to-1, right? If you have an ADHD, let's say adult like us, be perfect.
Mm-hmm. And Dave or Nancy?
Yeah, Dave.
So we're focused on 3 categories, and these are not subsectors. These are really broad categories, but essentially in investment theses around consumerism, and we believe that's a long-term trend. While we may not be the most equipped to invest in direct-to-consumer models today, we're very interested in B2B2C models because we think the underlying expectations and demands of consumers will drive interesting solutions that ultimately enterprises are going to need to respond to. We're also interested in what we're calling the data value chain. And so think of new ways to capture data, new use cases for data, new ways to present data, the analytics, and some of the basic infrastructure. We just invested in a company with Tony and PocketDoc that is providing some of the basic infrastructure for the transmission of data. And so we think that's a long-term trend that is highly relevant to McKesson and has interesting commercial opportunities long-term. And then the final category is pharma value chain. And this is thinking about pharma manufacturers and pharmacies and how they're going to respond to their changing business models and tools and solutions that will either make their business more efficient or provide higher quality. And one of the subsectors in that area that a lot of people have had some experience with is digital therapeutics, which we're also spending a fair amount of time in.
And the only thing I would add to that is, well, it's funny, when you asked the question, I was thinking about there's subsectors that seem to not, it seems like they won't go away. So Tony and I were talking about, I said it's my season for going to a lot of these competitions, and also it's for people who know HIMSS is coming up, so we're all heading to Vegas, which is not my favorite place, but if you look at the list of people who are at HIMSS, it is just unbelievable the number of ACO enablement companies there are. And I ran one of those companies in the past, so it's just amazing to me that new ones are still coming out when it's a market that is very small and hard to serve. And the use of the term big data and the use of the term of machine learning. And I just love asking entrepreneurs, what do you mean exactly by that? And they say, well, we mean that we're going to do that. Right now, we just sort of do spreadsheets and look at some data comparisons. So But the real answer for me, and it's obvious in our decisions around investments, is services. So I think it's really remarkable to me that services are coming back, the use of human beings in the process. So I think one of my big themes in life is that a lot of the tools that we hear about, that we heard about today, and that we see and that many of us have invested in, if you hand them to an end user, you will not get the desired result that you want. And so there are a lot of companies who are putting a service layer in. Service layer could be doctors, it could be social workers, it could be customer service folks like an Accolade, which is one of your investments, and putting them in and having those people take advantage of all the tools, these apps and other tools that we're talking about, to make sure that they're used properly and that you get the benefit out of them. So services are back.
Okay, just to add on the comments that both Dave and you mentioned about, first of all, consumer adoption, right? You have to design the product for the consumer, and then obviously when the consumer wanted convenience, enterprise sort of have to react to that. So actually a perfect example will be somebody like Doctor on Demand, right? Started direct to consumer, becomes very popular, thankfully to some of the founders, and but the company realized if it's a, that's interesting.
You can keep going on and off.
Oh yeah, okay, it's back again. Yeah, no, I'm good. So just to talk through that, what happened is they launched it. Yeah, so they launched it direct to consumer, right? Obviously they had a face because Dr. Phil was behind it, so they did very well. But the consumer actually really likes that experience, and the company doing well. But then the people turn around, it's healthcare. It should be paid by insurance or paid by a third party. So the company quickly realized, wow, it's a great, design the product for the consumer, but ultimately you find out who will be the payer, right? So quickly, obviously everything is nowadays self-insured, very much aligned. So hence the company sort of, I wouldn't say pivot, it go into a dual direction. We're still driving the consumer adoption, but meanwhile, enterprise have responded. And that strategy actually working really well for Doctor on Demand because they were designed for the consumers compared to some of the companies sort of hiding behind the benefit managers. Mm-hmm. So definitely, I really subscribe to that theory.
Go ahead, Steve. I was going to make a comment on trends. So my background is technology. And you were mentioning, it's so funny because I scribbled down big data machine learning before you said it. I think a trend that we see a lot at Dreamat these days with digital health companies is applying those theories in real world. I'll just give you two examples of Dreamat companies that went through recently. Had a great CEO, David Lindsay, who runs a company called Ancora. His mom had breast cancer, and at Penn Medicine, when they talked to the radiation oncology people, how do you figure out the dosing? He's an MD PhD student at Penn. Well, how exactly do you figure out the dosing, right? And they're like, well, He's like, wait, what do you mean, Well, And he just, his best friend growing up in high school was finishing his PhD in computer science from Georgia Tech, and they're using machine learning and big data and taking hundreds of thousands of records and patient records and EHR data to completely change the face of radiation oncology. There was a company that's about to come into Dreamat from Israel, similar, it's these patterns, just this trend of this technology that's so cool. Another MD PhD physician who saw a little boy in Israel die because of a medication prescription error, and trying to change that, and he realized, what if instead of drug-to-drug interactions, we just used a big data approach and said, should an 8-year-old boy be getting Coumadin? It doesn't make sense. It wasn't a drug-to-drug interaction. And they went back through 10 years of data in these Israeli hospitals, HMOs, and discovered, like credit card fraud, you can see this is out of boundaries. And so anyway, that trend, we keep seeing that big data machine learning being applied again in the real way of doing it, not like just spreadsheets, but really amazing new companies coming out with unbelievable insights that can go into those volumes of data.
It's amazing. We finally have the technology to pull some of this data together, which we heard about earlier today, and the opportunities really cool. are amazing. So, maybe we shift gears. So, when companies approach your organization, maybe we'll start with Nancy. What advice would you give them? I'm talking to the crowd here about sort of how to approach you, how to pitch your organizations.
If you run into any of us at a conference, make sure you follow up afterwards, because the chance that we'll actually remember to follow up with you will be slim. Not because we don't like you, just because you get bombarded. No, I think that, so I meet with, I'm sure everyone on the stage, I guess I meet with about 5 to 6 new companies, net new companies a week, usually on the phone, sometimes in person. And I would just say the advice is to really get to the value proposition in a very clear statement, and then the workflow. For me, I'm a workflow. I'm an operations person. Came out of healthcare delivery. I'm always like, got it. Okay, got the background on the market. Got that part. Okay, what problem are you solving? And then tell me quickly how you're solving it. And then a good sense, as I say, I'm judging a lot of these lately, of what is the trajectory in the market? What are the major milestones that you're going through? And it obviously depends on the stage of the company. But be absolutely clear about, we've all done it. There's sort of the next year is pretty clear, and then some miracle happens, usually about 18 months out on the plan, that is sometimes unexplainable. So to go through very deliberately and talk about what's going to be the most important milestones that you have to reach, and then obviously, what is your differentiation? To the conversation that we've had today, I see a lot of medication adherence companies, a lot of big data companies, a lot of analytics companies, a lot of, and it's very, very hard. And I really focus, as I know my colleagues do, on trying to understand differentiation, but don't come with the chart that shows you being perfect with every checkbox and everyone else being imperfect, but the real understanding of what the value, what the unique approaches that you have to the market, and don't discredit your competitors.
Thanks. Jack, how about yourself?
Yeah, I think it's important. So you're talking to a venture capitalist, right? So everybody try to get ahead of others. So the first thing you think about is, in healthcare, it's actually very different from most of the other industry. It's largely made regulatory driven. So if CMS says the wind's going to blow that way, you better go hit that, right? So you got to catch that. So it's very important to understand what is behind the driver, right? Whether it's regulatory, other mega trends. So for us, it's very important to understand that, get it in front of that. Then you turn around, typically the things that we looked at, I think oftentimes looking to an entrepreneur, which they couldn't answer is exactly how big that could be, right? Because we're dealing with a very siloed healthcare. Can we scale this business in the US, right? If you can't, then we probably shouldn't touch it.
Maybe some really practical advice about what not to do. Don't come and tell me you're going to be the internet of healthcare, or you're going to be the Uber of healthcare, or the Google of healthcare. These sort of hyperbolic statements often, I think, destroy credibility in healthcare. So I think, the best way to get to a venture capitalist or an investor is to get an introduction from somebody who's credible for that person. It is hard when you are trying to do exactly what Nancy's describing, which is differentiate all the stories that are very short, the good from the bad, when you don't have any ability to put it in context. And so if you have somebody who is a credible person and a referral, that's probably the best way to get a longer conversation than a very short conversation. And I think once you get that conversation, I really liked what Nancy said. I wouldn't waste the time on explaining how big the market is, because in general, we probably have a good sense for whether or not it's a big problem or a small problem. I would get to what it is you're providing and why somebody's going to pay for it, and specifically who's going to pay for it. And if you have customers who are not pilots, spend your time talking about that, because I think we're in a world, this is probably the pilot phase of digital health right now, meaning lots of companies have pilots, but also digital health is in its own pilot phase. And so I think when we get to the next phase where people are actually paying for digital health solutions, that's when the differentiation starts to happen, and it makes it easier for us to actually distinguish one company from the next.
Steve?
Good.
Well, if you've met those people who meet Lema, I know that I'm not involved in that process. We actually put Jody and Jess in front of that, and we did process the hell out of it. So for us, if you're going to come approach us, the first thing is ask Jessica what our point of view is, because we're a point of view fund. We actually do our own primary research about what we think needs to be solved, and then we try to go find those companies. And if we can't find them, we've actually started 3 of them. So I think the really smart question is do your homework on that fund, whatever fund it is, and then ask them a question about, what is it you're looking for? Or I know you guys you want to change coverage. I've got this great idea about how to change coverage and make it as affordable as a gallon of milk a week, right? So not enough time. And then what's so odd is we see, 250 companies a year, and they'll start by saying the size of the market, and I'm just like, yeah, don't waste my time. We've done that homework, right? Tell me what it is you're trying to do, and again, do the homework on the fund, and you'll have a better chance of actually making the synapses fire.
Thank you. Answer?
Steve, yeah.
So for approaching somebody like Dreamit or any of the venture accelerators, so we run on a cohort basis and you apply. It's like getting into college, right? So you just follow us on Twitter and like, when's the next cohort? You can always talk to any of us at a conference or anywhere. So that's how to kind of approach us, and you apply and get into that queuing. The things that we look for, I'll just to add to what some other people said, I love to hear an entrepreneur, and I'm an entrepreneur, right? That's where I started. What's the unique insight that they had? So yeah, it's a problem. Okay, what's your unique insight about, by the way, did you know diabetes is a really big market? Well, I need to spend 5 minutes telling you that. But anyway, no, diabetes is a huge market. Yes, I know it. But what's your unique insight? And what's your unique solution to that unique insight? So something crossed your mind at some point. You came up with something really different. What was that? And what do you think everybody else in the market's getting wrong? Right? You have such a unique insight. Everybody's trying to do it this way. We're trying to do it this way. We love everybody's zigging. Why are these guys zagging? And then the other thing, and a couple people touched on it, but the term I like to use, which is what Roy Rosen from Penn Medicine, Chief Innovation Officer at Penn Medicine uses, is, what evidence do you have? It's huge. Everybody's going to want it. Cool. What's your evidence? Well, it's why I need $1 million. Well, no, why don't you go talk to 10 healthcare systems and come back? Don't wave your hand. So like evidence, and evidence could be real market traction. They're in the market and they have customers. Start talking about that. Or the evidence could be, we've talked to 10 people. And your dad or your mom or your brother doesn't count. It's got to be real people. Get out of the building, like Steve Blank. Yeah.
Could I add just one other thing? It's a real privilege for, I think, all of us to work with entrepreneurs, and we know how much you have invested in these ideas and concepts. I think one thing that's very helpful is when that's combined with humility. And so when there's an acknowledgement that you don't have an answer to a question, or you don't fully understand this certain part of healthcare, that goes a long way in these short conversations, that not only do you have the passion, the vision, the resilience, the creativity, but you also have the humility that goes with it, because both are required to be successful. And I think that's one of the things we're looking for when we sit down with entrepreneurs, is that you've got both of those.
Well, I want to open up to the audience for questions, if folks have them. Yeah, would you mind coming up to the microphone, please?
Where do you see the venture capital funding in the next year or two? It seems to be slowing up. I've been getting a lot of referrals from a really great university for my investment banker. The New York guys are saying that it's really going to dry up out here. So what is your comments to that?
Do you talk about venture capital and slowing down in general?
Yeah, the funding,
Yeah, sure.
Right, because, the investment bankers, NEBA, has over 200 investment bankers, and, we're getting referrals daily out here from major institutions. I'm talking about in healthcare, biotechs.
Yeah, well, in digital health, actually, if you pay attention, by the last couple of years, at least if you look at the Rock House report, it's been going up every year. Last year, 2015, barely exceeded 2014. I'm pretty sure this year it's going to be hard to eclipse that, right? So we'll see how it goes. But clearly, everybody pay attention to the oil price in the public market, as well as the Black Friday. I don't know if you saw the SAS drop 45% valuation. So clearly, from my perspective, obviously people are a lot more realistic. But I think we were just talking about the corridors. One indication I have is, and you talk about 4 or 5 meetings every week. Obviously, I don't work as diligent as you are, but I see my number goes double.
Yeah.
I actually look at my CRM. I was doing the compilation, exactly double. Now, obviously, JP Morgan comes a lot, but pretty much what happens nowadays, if your company raising capital, it used to be called 20, now you gotta go call 40, right? So make sure David and I are on the list.
But you're second.
We'll compare notes. Yeah.
Nice.
Look, I'll jump on to what Jack said. I don't pretend to know what's going to happen. I think that a lot of money has been raised in this asset class and among venture funds, and you have a confluence of healthcare investors and then also tech investors who are looking at healthcare as a really interesting place to be putting money to work. I do think that some of the later stage crossover investors, that will dry up in the next couple of years because their risk appetite is going to go away. I think, this is an opinion, I think that some of the tech venture investors will lose interest in healthcare over time. They'll begin to realize how difficult it is to scale businesses in healthcare. And so I think over time we'll probably get to a more rational amount of capital being invested in these types of companies. But I don't pretend to know how long that's going to take for that to happen.
So maybe I add one more comment before dominating the conversation here. But last year, if you look at the IPO market, certainly I would consider last year was a real first year for sort of a digital health company going public, right? There's 5, 6 of them and went versus a year before, maybe Castlight, the only one, Aviva you can think about. So what happened is there's a bunch of opportunistic buyers on the street, right? Some are from a biotech. Traditionally, they go, hey, it's great. This is something I can relate it to, starting to buy these stocks. Likewise, then tech investors also starting to buy these public traded companies. And both of them, as you know, unfortunately hasn't done very well. So you'll see that this year is going to be a really, really difficult for digital health company going public. It's just the appetite from both sides is waning right now.
Well, we call it the great healthcare IT washout. So, yeah, I mean, if I was a company trying to raise capital, I'd start thinking about what my M&A strategic options were. Or, valuations, when there's so much capital gone in, you have to prepare yourself for a down round or do, a flat round, and that's going to be painful for some people. But sometimes getting through a down round and getting a chance to see the light of day is what entrepreneurs need to do. So that's going to happen to people. And, I don't know if there's a rational amount of money that ever gets put. I don't know what that means because you're talking about one of the most important industries to the human race. And, I always laugh about people talk about, how much money we spend on the GDP in healthcare. And I say, if there's one thing I want to be exporting in America, it's healthcare. So I want to keep investing in healthcare. Unfortunately, we have the illness burden treatment system. It's really not the healthcare system yet. But, hopefully we're going to get there someday.
Other questions from the audience? Yes.
Yeah. I get to ask questions, don't I?
Yes, go for it.
So Tony just touched on it, valuations and down rounds. So can you talk a little bit about how are we seeing down rounds? And I know there are a lot of seed stage and early stage startup founders here trying to figure out how much is a realistic raise for those stages and how much what kind of pre-money valuation should they be thinking about today versus, let's say, last year, 6 months ago?
I think there's actually 2 parts of it, if I may just get started. One is obviously the seed companies and Series A companies try to raise a Series B, right? So I think there's a huge overhang. I think there's so many companies get funded, so many incubators churning a company, and none of those companies actually, I shouldn't say none, majority of those companies hasn't hit the milestone they're able to raise a Series B, which is meaning we talked about earlier, customer attractions, right? Ideally to see in the millions of dollars to get that Series B, just to get funded, let alone the valuations. Second is obviously we all observed last summer some irrational behavior because there's so many people are interested in this sector. So the tech investors, international investors coming to this place. So the deals that traditionally priced at $50, $60 million now it's $150, $200. Now one thing I have to say, some of the people insider realized this is dynamic, so they were actually clever enough to raise enough money because the valuation was good and the interest was high, so those companies raised lots of money. So hopefully that batch of company will get through this crunch. Now, however, there are a bunch of companies that hasn't taken advantage of that. So I think if you were to come into the market today that you haven't lived up to the expectation that you're hoping hundreds of millions of valuations, you're going to be very disappointed. So lots of bridge rounds, in my opinion.
I think what I would add. So it's interesting to me. This is the first time I've been on the venture side. I've always been on the entrepreneur side, and watching the valuations that I'm happy to say we did not succumb to in our fund, the ones that were just insane, and we know what they were. I remember thinking about the venture capitalists who were accepting those term sheets, and usually from people who were not, who were some of these non-healthcare players. And I thought, you know what, you're going to have to live with that. I mean, you better be able to live up to it. I mean, it's not like you can run and hide anywhere. It's based on something, and you're probably riding it high as those big valuations are coming in, but you're going to have to actually prove yourself in the next round. And I will all day long, and I did it myself, take a investor who knows what they're talking about with a lower valuation, one that I can absolutely get behind, in fact, blow out of the water, and then make it up in the next round. So I think, coming out of, I lived through the Athena Health growth days to the IPO, and it was not meteoric. It was slow, steady, painful, fall down, get up, do it again. And we had the appropriate valuations, and over time, it all paid off. But that was a real company with real capabilities. And so anyone who's out there doing a deal with the devil is going to end up paying for it.
But just to add, so we're very early stage, and you guys are all much later. And we do both pre-seed and post-seed. So we have a new program at Dream called 00, which is for post-seed companies. They come in, we give them no cash, we take no equity, they go through, and we just get an investment right in their next round. It's really cool. And a lot more companies are coming to us for that. But I think what's interesting, and you guys could comment better, if you're doing a Series A or a Series B, and we're really targeting companies to get to the Series A, right, is I think what you were asking, what should people in the audience be thinking about, is you should be talking to a seed investor, a Series A investor, saying, what metrics would you need to see to write a check? Don't forget, raising capital, when you do VC, you're selling. They're your customer. You have to ask what they want, right? So most of you, I would assume, for a Series A, are going to say, for a digital health company or whatever you're doing, if you're B2B, we're going to want to see $1 to $3 million a year in recurring revenue stable, right? I don't know if that's kind of what I always think in the back of my mind. So if you're post-seed pre-A, just know that's your hurdle. That's what you have to hit to be able to get that round of investment. And you should be spending time with investors, asking them that question. And you want to get way ahead of it. Remember, it typically, and again, correct me, just data, that we always talk about with entrepreneurs, figure it's going to take 3 to 6 months to close a round. So if you've got a year of cash left, start casually dating investors and saying, look, what would you need to see from us 12 months from now? Because I want to be able to come back 6 months from now and start showing you I'm getting there. And you date before you get married. So you start warming them up, but understanding where you need to get to as a company is a really great way to do it. And I see very few entrepreneurs do that. They just kind of guess at the whole process. So.
One more question from the audience here?
Yeah, real quick, let's talk about FTA. In terms of, in 2015, there was a high throughput at the FTA. They were getting more deals through, or more, I guess, acceptance. Are you guys looking at deals, entrepreneurs out here, in terms of FTA, where should there be in terms of trying to get their idea through? And would you guys be investing, and what stage would you invest?
We don't do FDA investment, so FDA required.
So we do a little. So actually, to add to the comments before, and many of us imply that if a company to raise some capital, a Series A or Series B, you will require to demonstrate some kind of revenue. Now, if you're a regulatory bounded company, that you obviously don't have any revenue to show for, right? So we do have to be very cognizant of that. So some companies are obviously not comfortable to making, VC firms not comfortable to making that pre-FDA, some are. So that's a binary question you should ask. Some is okay, some not. Some is actually okay with things are proven, there's a predicate, they're comfortable. Others are okay to do de novo, right? So everybody has different tolerance. So if this is your gating item, just ask. I don't even want to spend the time with people that don't have answers for that.
Generally, I would say that there are different types of funds that and VCs that will cater to that type of high beta environment. And if I were to characterize this group, they're probably a different mindset. So it's really about who you're approaching.
I would just say we will take things that are FDA, so we're a little different.
Yeah.
We like to see that the entrepreneur, though, has a path to that? Do they understand what they're about to do? We work with a lot of Israeli companies now that already have a CE mark, and they're coming this way.
Yeah.
So it's a great stepping stone. It's like it's easier to get, and you talk to them, and there's an intelligent thought and process behind it. It's not just a hand wave. You know, just like we have this really great idea. Okay, well, how are you going to approach that market? How are you going to approach regulatory? And they have a thought process. So if you have a thought process, and it's a really cool idea, it's unique insight, big market, sure, we look at things like that, even devices. So.
That's good. Well, I don't seem to be yanking us off the stage, but I see our clock is a minute behind. So I'm going to thank our panel and thank you all in the audience for your participation. And we'll all be up here after for questions.
Thank you.
Good job, Mike.